I'm Rachel Ziemba. I've been delighted to be a wonk for the last few years and an advisor to global wonks for much of that time. My background is as a country risk expert and focusing very much on country risk resilience and the scenarios that might drive the global economy. So what I'm going to do today in my remarks is to think about some ways in which COVID-19 and the policy response to COVID-19 is shaping the outlook for emerging and frontier markets, not only today and this year in 2020, but for the coming years. And then I really want to focus my attention on the way in which COVID-19 and its response might reinforce some trends that were already happening in the global economy and bring some inflection points. But really, I want to put some things on the table so that you can ask your questions, because that's where I think the most useful part of this dialogue will be. Among the trends that I would see reinforced by this crisis are the localization of supply chains, particularly in large economies, the reinforcing the relative strength of balance sheets of bigger economies, and also those with stronger balance sheets. I'd also see greater government intervention in trade and investment going forward, not only in healthcare. And I don't see a meaningful shift in the ongoing distrust between major powers, including the US and China, or the transatlantic relationship. And that all has implications for the emerging and frontier markets that are important trading partners with these countries. So, but briefly, what's happened? What's been the economic impact fully is an interlinked health, economic, and financing crisis that's been amplified for many emerging markets by the sharp drop in the price of oil. That, of course, is a demand, that reflects a demand challenge, of course, but it's also amplified some of the financing challenges. As with major developed countries and China, many emerging markets, including India, South Africa, Mexico, have adopted degrees of stay-in-place measures and partial lockdowns to try to address the health crisis. These countries, as a result, have had to figure out how they can have financial lifelines for the population and businesses. Much in the global economy today, there's a lot of talk about stimulus. I would tend to focus in on what's really stimulus, supporting demand, and what's really just trying to keep institutions on lifeline and service their debts, because that's going to play a major role in whether both those debts are sustainable, but also on the type of growth we see going forward. Ultimately, there's a broad trend across emerging markets that they do have less policy space to roll out big support packages as we see in developed markets. There's some exceptions that we'll get to, but we've generally seen emerging market countries facing that challenge. So the broad macro story is really one of a consumption and demand-driven crisis. This makes it quite different from other global shocks that we've experienced in the last few decades, particularly since the global financial crisis. It had a demand impact, the global financial crisis, but it was much more a manufacturing and manufacturing crisis that was driven by an initial financial shock and crisis. But ultimately, what we're seeing now is, in a sense, amplified by the fact that global economy and many emerging markets have been more and more driven by services rather than investment, rather than manufacturing, and the like. So if we look ahead, this suggests to me that in some ways, countries that are more linked to key manufacturing channels, including global technology chains, might be a bit more resilient. Those happen to be Asian countries that also might tend to have stronger reserves and balance sheets as well. But I do think, if anything, some of the stimulus we're likely to see might support both technology-related investments in infrastructure, as well as, of course, health-related manufacturing, infrastructure, and the like. But in that context, but it will be sectors that are most consumer-driven and in-person delivered services that I would see lagging. The fall in the price of oil has been both quite severe and continues even as we speak to experience significant volatility. What drove this is again a major demand shock that was exacerbated by a increase in supply. Exactly what you don't want to do when the global economy is going into engineered a recession and a medically induced coma. As in this sector is going to face significant challenges going forward, particularly in places like the United States, where supply will come offline in a more volatile way, but also across all major oil producing regions. I don't really see any winners out of this, but there are countries that are better able to cope with it. Typically, when we see a big drop in the price of a commodity like oil, we think we start revising our estimates of balance sheets of countries like India and South Korea and South Africa and Turkey, countries that are major importers of this commodity. What I fear is that in this context, demand is more constrained in those countries, and the financing shock and demand shock that comes along with it likely outweighs it. But that will be something important to watch. I've written recently about the fact that it's been surprising not to see major buyers coming in and either building up their strategic petroleum reserves or other measures to provide some support to those distressed assets. So, I've told this story of a short, sharp, well, we don't know how short, but a sharp shock, major sort of decline in economic output, what the IMF has called the Great Lockdown. And I would agree with their assumptions that the economic hit is likely greater than in the global financial crisis due to the scale of the global economy shut down. Where I don't sort of share all their views is that I think the recovery might be a little bit more staggered, and that there might be more meaningful balance sheet effects that shape and lessen the pace of growth going forward. So one of the things I look at when I am thinking about the economic growth rate going forward is to look at some of the relative data coming out of China. China, of course, the first country to go into lockdown, the first country to begin in an uncoordinated, in a way to exit, and a country that I think really reinforces this story that while all sectors of the economy have struggled, it's really the demand side that has been more of a problem. Back 5 or 10 years ago, we might not worry about that quite so much. China was driven by investment. China was driven by exports before the global financial crisis. Consumption wasn't a major sort of driver. But we see that shifting, and the fact that, and so I'll be watching very closely whether the Chinese consumer data starts to show a reversal as we see data from March and April, May, and June, because I think that will be quite important, not only for global demand, but also for looking at other countries. So what might the rest of 2020, 2021 look like? Well, of course, the big critical uncertainty is the public health success. Are there multiple waves of the crisis that bring further shutdowns, perhaps more targeted, or is this addressed through greater testing and contact tracing that allows a move more quickly, perhaps, to a new normal? That new normal is probably going to mean many less a reduction in density in many parts of the world. But so that's the key question. In the scenario that we avoid another big lockdown, I would see modest, a bit of a bounce back as some output comes back online, but this will be very sector dependent. Demand patterns will shift, and the increase in unemployment won't go away overnight. And that's something that can be particularly painful for a number of emerging markets that rely heavily on an informal sector or on the gig economy, and may lack benefits. Countries without automatic stabilizers and benefits look particularly exposed. So too are countries heavily reliant on tourism revenues, and that's something, of course, we can delve into in more detail. Either way, some form of recovery in the second half of 2020, as the depth of contraction slows down, stops shrinking as much, and the like. But there are risks of structural declines because of balance sheet stress, loss, the weakness of household balance sheet strength. And so my scenario is more of an L-shaped recovery in many countries, and in some places we could see a W. So one other critical question is really on the financing side. This really continues the cycle for emerging markets. We've seen a retreat of capital from emerging markets in this crisis. That's not atypical for a sort of for a crisis like this, but as the Institute of International Finance has highlighted, those capital outflows have been much greater in this crisis and sharper. And not only have non-residents, so foreign investors, been less willing to invest, but some locals have reinforced move to dollar assets. So at the same time, we have lower portfolio capital outflows. We have less FDI because people are uncertain about demand. And we're also starting to see another risk relevant for emerging and frontier markets, and that's the drop of remittances. Remittances have actually become one of the largest sources of capital into emerging markets. They're more important to countries like the Philippines, Egypt, Mexico, Kyrgyzstan, many South Asian countries, but they're sort of quite relevant as a source of consumer demand and construction capital across many emerging markets. So what we're seeing here is a coincidence of financial shocks. And this is one of the reasons why I would see that the crisis has the risk of reinforcing divides between countries that already have market access, that have stronger balance sheets, that have less debt in the emerging world, and those that were maybe already headed towards debt distress beforehand. So what does this all mean for policy space? Historically, the old adage was that emerging markets had less ability to do stimulus, whether it's monetary or fiscal, than their developed market peers. That line, I would say, is a bit blurred. And we can also talk in the Q&A about whether I should be looking at all emerging markets in this group, but that's a side point. What I think is most important is that, in general, when I look across the emerging market and frontier space, balance sheets are weaker than they were in 2008. That's because fiscal policy was used. Credit stimulus, in many cases, was used. There has been a bit more support on the monetary policy side. Interest rates have been cut across the board, and some greater use of credit stimulus to try to support funds to small and medium-sized enterprises, for example. But this has been a constraint. What I think is most interesting, though, is that this is a time that emerging market policymakers are pushing the boundaries of how much space they really have. In the last week, we've seen South Africa roll out a package that you can add up to almost 10% of GDP. That's quite unprecedented. Now, I might be skeptical of how much they can actually roll that out, how much is new money, but we are seeing some countries move beyond what markets would have thought was or what what they would have thought was the policy space they have available. That I would highlight that when we compare G10, G20 policy responses, we see that countries like India, China, Saudi Arabia are among those that have done fairly little on the fiscal side, or in some cases, like Saudi Arabia, actually plan to cut spending. So that I would see as a concern, because cutting spending, particularly in a very government-driven economy like Saudi Arabia, actually reinforces and amplifies the economic downdraft. So if the financing issue is of concern, who's going to provide this finance? This crisis has prompted an unprecedented need for liquidity. Over 100 countries came to the IMF and asked for short-term liquidity. Now, short-term liquidity to try to avoid solvency issues. And one of the outcomes of last week's IMF and World Bank meetings was to come to an agreement on deferring debt payments for the poorest countries, as well as speeding up some of that liquidity support. When I look out at what countries need money, I see about four groups here, and the policy responses need to be somewhat different. The first one are countries that were already in debt distress, places like Lebanon, places like Argentina, and countries that maybe were already negotiating, but it's much harder to figure out what is sustainable debt right now. Then you have another group of countries that, largely because of the oil decline, are facing what was a already unsustainable debt burden, but it's just become an acute problem. Those are places like Oman, Bahrain, a number of other North African countries. They might receive some regional support, but they don't have enough domestically. Then we have a series of larger, more liquid emerging markets that are experiencing capital outflows, and they either have meaningful fiscal vulnerabilities like Brazil, or external vulnerabilities. Or like Mexico and South Africa, they've been facing economic stagnation for several years and don't have a lot of policy space. And finally, you have countries like many in Asia and even some rich countries in the Gulf, where you have some shorter term liquidity needs to help meet the needs of the private sector and the like. So those are more manageable. So who's going to meet some of these liquidity needs, and how do you even differentiate between liquidity and solvency? What we've seen is the Fed roll out some swap lines and other measures. There are very few countries that can actually take advantage of that. The IMF has many new programs, but it only moves so fast, and there's a lot of politics involved from member states, something we can come back to. Their new swap line might not have much stigma. Stigma has always been a concern, but very few countries have quote unquote good policies right now. We might see the World Bank and regional development banks providing some more support, but the scale of providing the funds to be able to avoid the kind of cuts in the healthcare system is a challenge. The other place I'm watching closely is whether we'll see more bilateral support. In past crises, we've seen China come in and provide lifelines, provide swap lines, give oil-backed loans or other commodities. We haven't seen that in this crisis. One reason, arguably, is because they're still renegotiating debt service issues about the past debts. The other is more generally that the Chinese policy response to this crisis, at least on the economic side, has been more modest so far. It's likely that they may hold their firepower for a later phase in the crisis. So I want to conclude with, right before we get to your questions, with just a couple final thoughts on how the global trade and global investment environment will be impacted. First trend I would see that I would see being reinforced by this is a shift, is a shift to somewhat more localized supply chains, particularly in major economies. We've already seen some of that deepening of supply chains in China, some moves and greater use of automation in countries like the United States. Politically, of course, the Trump administration is very focused on that, and I would argue it's somewhat of a bipartisan priority. Though happy to talk more about how U.S. policy might shift after the election in the Q&A. I also see businesses having to think about the building in redundancy and into their systems. What do I mean by that? Not relying on one sole hub, including China. Not relying on only sort of one element of a supply chain. Of course, building in redundancy in good times brings greater costs, but a series of different shocks, not only COVID-19, likely reinforce that. Ultimately, I see the trend of greater government involvement in screening investments as one that will stay. I mean that both in a quote unquote in the sense that there will be more screening. Entities like CFIUS and their counterparts in the global economy will block more deals. But I also see that much of the investment that does take place, or more of it, will actually come via government co-investment platforms, sovereign development funds, and the like. So I see government being more involved in regulating investment and other flows, and that's something we'll also see in particular in some of the resource sectors. In addition to those trade and investment restrictions, we're likely to see more migration restrictions. Some of those brought into place, the travel restrictions probably won't be fully lifted as quickly as some of us might hope. This is going to put more strain on certain sectors that relied on those flows. So we have this core scenario where there's greater use of export and investment controls, including migration, and also a dynamic where across many emerging and frontier markets, a greater government role in the economy as a pump priming and as funder of major investments. This is not necessarily a bad thing, but it does always depend on what the goal is and how it's financed. And we'll put the elements we've already been concerned about around the contingent liabilities, the financing needs of state-owned enterprises, national oil companies under more scrutiny. Finally, I see that this is likely to have some opportunities on the sides of financial technology, the use of digital currencies, extension of credit access to people that have previously been unbanked, and I would see more technological solutions along those lines. This is going to take place in an environment where the US and Chinese technological conflict and contestation is likely to increase. But I do think that particularly that we'll see additional innovations in that way. With that, let me conclude and hand back over to Michael, and I really look forward to taking your questions.